Before starting to build a financial model, it is important to understand what is a financial model and why is it created. Hello everyone, welcome to this second session of financial modeling of a startup series. And in this video, we are going to cover what and why of a financial model. So let's get onto the screen and understand what are we going to cover in this second session. So here we are at module 2, which is introduction to financial modeling. And in this entire session, we are going to understand what is a financial model, what are the use cases of financial model. We are going to understand from a perspective of a startup or a company how a company can use a financial model and how industries in finance are using financial model. We are taking example of investment banking over here, why investment bankers create financial model. Then using a real life story or a case study, we are going to understand how my experience in financial modeling was, where we used a financial model for our client and helped them get a better result. So we are going to understand the entire case study, what bad models look like. So here we are going to understand what are some of the bad models, that is what are some of the missing points that you should take care of while you are building the models. And then we come to do's and don'ts, which is on the basis of bad models. So bad models, here we are going to see examples where we are going to see some of the reference model which are not up to the mark and what should be taken care while you are building a model. And finally, what you will build in this entire series. So how are you going to benefit when you complete this entire series, and what will you learn for financial modeling? So moving on to point number 1, what is a financial model? So here we have a definition of financial model and how is a financial model built in a simple sentence. So financial model is a representation of companies expected financial performance, often used to project financial statements like income statement, balance sheet, and cash flow statement. So here we are understanding about financial model, that it is a representation of a company's expected financial performance. Now a company's financial performance is measured using three financial statements, so that is income statement, balance sheet, and cash flow statement. When one goes through these entire statements, they get an entire picture of the business, of how is it earning profit, what are its assets, what are its liabilities, and how is the cash being generated in the business. So here we are saying that a financial model is a representation of company's expected financial performance, that is, it is portraying what the company will do in the future. Now how does financial model work? So financial model is a tool that combines historical data, assumptions, predicted trends to estimate future outcomes, helping businesses make informed decision and external parties assess value of a company. So here lot of the companies use internal financial models to make decision for their business. So for an example, as a company owner, I see that the industry is going to grow 10%. So I will create a financial model for my company, and in that I will assume what is the revenue that we are expecting to generate from the business. Since industry is expected to grow 10%, what will our business be growing at? So that is what we are making assumptions about. Now the second example is historical data. Now in the historical data, you are seeing what the company has been growing in the past few years. So here you are seeing data for the past 3 years. For an example, if you see that the company is growing on an average by 20% every year, so in the future you can take that particular rates as the growth rate for the coming years. So that is how you use historical data. And finally, the predicted trends. So predicted trend is somewhat like assumptions only. Here you are seeing that industry is expected to grow 30% in the next 3 years. So here you will assume that in the first year you will be growing 15%, next year 10%, next year 10%, up or down from the industry rate. So that is what you will predict in the trends. Now for an example, AI is one of the biggest trend in the market. So here you can assume that AI is going to grow very big in the coming future. And if your company is into business with AI, then you can predict that your company will also be growing at a faster rates than other comparable industries. So that is about predicted trends, where you are assuming which industry is going to grow faster, and based on that you are making your assumption for growth rates. So a financial model works by combining historical data, assumption, predicted trends to estimate future outcomes. So that is what we understood, that using these three types you can then predict future outcome of what the business is going to generate, and this will help your business make an informed decision. So here you can see if your business is going to generate 100 crores from last year's 80 crore, so what are the expenses that you would have to incur to get to that 100 crores? Is it more manpower? Is it more marketing cost? Is it more business development cost? So that way you can then predict other line items as well based on these three types of assumptions. So that is how a financial model helps businesses make informed decision, and it helps external parties assess value of a company. So this is one of the most important thing that investment bankers use. So a financial model is used by investment banker to calculate the company's value. This is done through a model called DCF valuation model, which is discounted cash flow, where once you create entire financial model using three statement financial model, you calculate the value of a company using this DCF term. We are going to understand about this DCF in coming sessions, but for now this was about financial model. So DCF and financial model are not same, but they are different elements which helps a investment banker to calculate the value of a company. So a financial model will be the first step in the entire process, whereas valuation comes as the second step once you create the entire three statement financial model. Moving on to the second point, that is where are financial models used. Here we are going to see two use cases. First is for investment banking companies and second is for a startup. Since we are doing a financial model of a startup, we will see how a financial model can be used by startups. So first is investment banking. So investment bankers use it for valuation of M&A deals. So whenever you are working on a M&A deal, a financial model is created which assumes what are the synergies when you are merging a particular company, what are the acquisition synergies that a company will get when they acquire a particular company, and that entire thing is put into the three statement financial model, and using that a company's value is calculated. So that is not what our main agenda is for this entire session. It is to understand about financial model. So financial model becomes the basic step of calculating a valuation for entire deal or a company. Next is IPO pricing. So here also in IPO pricing, a financial model will help to calculate the value of a company and come to a fair share price at which the company can list its share on the stock exchange. So that is what financial model can be used for. Then it is used for projecting clients financial for pitch deck. So in a pitch deck there are a lot of numbers that you need to input, and here financial model will help you put the KPIs of each of the line items that you are projecting. So a financial model is definitely very helpful when you are creating pitch deck, so that the numbers from the financial model can be used in form of bars, graph, chart, or various representation type in the pitch deck. So that is a thing that investment bankers use for. And finally, calculating valuation for equity dilution. So this is similar to the valuation for M&A deals, but here this is used in the case of fundraise, where you are not going for M&A or something, but you are raising funds through venture capital or someone, and you are calculating the dilution that you will have to bear when you are raising funds from them. So a financial model is definitely helpful over here as well. Now in the case of startup, so let's now come to internal side of a financial model. How is it used by a particular company? So here fundraising decks can be made using a financial model. So similar to investment banks, if you want to pitch your company to VCs directly, then you can create a financial model of your own internally and then plug in numbers from that entire financial model into the fundraising deck that you have created. Next is revenue forecasting and cash runway. So this is what we discussed in the first slide. What is a financial model? So it helps business get expected outcomes of business. So here you can definitely forecast revenues based on the historical data, based on the future trends and assumptions, and then based on that you can then project what is the runway of cash you will require to get to that revenue forecast. So as in the example I mentioned, if you are projecting to get to 100 crores of revenue from previous year's 80 crore, then what is the more expense that you got to bear to get to that extra 20 crores of revenue? So that can be calculated from the financial model. And finally, unit economics modeling. So most of the time we see on the Shark Tank that what is your unit economics. So here financial model helps us to get to that unit economics as well. So for an example, if you are doing revenue of 100 and you have, let's say, cogs of 30, then you are doing marketing of, let's assume, 20, then you are doing other administration expenses of 10, then finally 30 20 you are left with 40 as your EBITDA. So 40% is EBITDA. Now out of that you will subtract depreciation, let's assume 10, interest, let's assume 10. So you are finally left with profits of 20. So that way you calculate the entire unit economics, and these can be easily calculated using a financial model. Next is budget planning and burn tracking. This is similar to revenue forecasting but more on the expenses side, where you are seeing what is the planned budget for the company and how are you going to burn and measure that entire expense of budget. So that is the entire use case on the startup side of the financial model. So as we mentioned over here, every major business or deal decision is backed by numbers, and financial model make those number meaningful. So you cannot directly go to any particular investor and tell them that we are going to go and do 100 crores of profit next year. So they are going to need every detail of how that 100 crores of profit is coming into the company, and what are the assumptions and predictions that you have made to create the entire financial model. So the entire financial model helps to portray a story to investors or anybody that you are pitching out your business to, and it will help a business owner as well to understand how the business is performing by analyzing various trends and getting a picture of the entire business model in the single financial statement. So as we saw that financial models are very important, they become the backbone of deals. Now we are going to focus more on the deal side, how financial models are created, so that when you get into your job in investment banking, in a private equity research side, you are more aware of how financial model will be helping you on the job. So number one is numbers plus storytelling. So a financial model is all about numbers, that we got to know from the previous slide, that it is helping businesses to calculate valuation, it is helping in unit economics, but the major element that is that it is helping business portray a story. So financial models are more than just calculation, they narrate a company's financial story. So that is important. So for an example, let's assume that company was doing 20% profitability for the last 3 years. Now and this year the company has profitability of minus 10 years. Now a financial model will help a investor or a business person understand why this minus 10% came into the picture. Was it due to fall in revenue? Was it due to increase in some kind of expenses? Was the marketing expenses bit more than previous 3 years? Did we pay more to the employees? What was that? So if you do a trend analysis of previous years, you will get to understand a picture of the company and get to know the story behind this minus 10%. So that is what helps investment bankers, private equity firms understand how the company is performing and is it worth your time to do deal with that particular company. So that is what we can understand from the numbers, and they allow bankers to represent businesses in the best possible light for fundraising and M&A. Because it is duty of bankers to make deals happen, you have to create a financial model in such a way that it portrays good story about your business. Since the first filter of working or not working with the deal is understood by the bankers, now it is their duty to make the business deal ready. That is, you have to create an entire storyline around a business of its future glory, and that can be done through the financial model. Now the second element to working on financial model during deals is that it helps break complex into simple things. So here model breaks down integrate financial into actionable insights, aiding decision making. So while going through a financial model, you can easily understand what was the point which has to be worked upon and make suitable changes to that. There are definitely a lot of models which are very complex to understand, but someone working in the finance industry, it becomes your duty to make it very simple to understand and easy to go through, so that it could be easy to explain it to others as well. And finally, it is critical for deals. So definitely while you are going for a fundraise, M&A advisory, a financial model is a must, and without it you cannot proceed in the deals. And it provides transparency, aiding in negotiation and deal structuring. So this point is also important, that it helps in providing transparency. So here you are mentioning everything that business is going to do in future. So for example, your company is raising 100 crores. Now what is that 100 crores being utilized towards? So that is what you will provide in the entire financial model and be transparent about it. What is the management going to take as their compensation? Is it 10 crores? Is it 15 crores? What is it going to pay towards other employees benefit? What is it going to spend towards marketing? You have to predict every line item and then put it in the financial model. and this will help in negotiation. Now whenever you are talking to an investor, at that time there will be negotiation based on what you have put into the financial model. They will give their inputs on the entire financial model that you have created. Are they happy with the management cost that you are assumed as a founder? Are they happy with the profitability that you have predicted in the entire financial model? And there are a lot of negotiation that takes place for the entire finalization of financial model. And finally there is deal structuring. So what is the amount that you have to raise? You can get an understanding from the entire financial model, and that way you can then structure your entire deal. So here we understood that financial model definitely becomes a backbone of the deals that are happening in the market. So the next point is a real life story that I had personally worked upon, and what was the impact of creating a financial model. So here we are going to see step by step what happened and how creating a financial model helped the company raise funds at a higher valuation. So this was back 2 years when a company which was in our network, that is our founder was very well connected to the owner of this company, and they were raising series A for expansion. That is, they were into a marketing business. It was a barter marketing company, and they wanted to raise funds to expand their distribution line, get into technology, create an application, and for that they wanted to raise funds through a VC. So here they were approached by a fund. So this was a VC based out of Delhi, and they wanted to take an equity stake in the company at a 20 crore valuation. So here the fund was offering 2 crores to the company and wanted to take equity stake in the company at 20 crore valuation. So here the founder of that particular company came to our founder and mentioned about this particular deal that he got from a VC fund. So once we got to know about the entire deal that was pitched to our network company, we then had a look to what was the proposal that the venture fund had pitched it to them. The next thing that we did was we had a look to the financials of the company and got to understand that they were being undervalued a lot. So here we took the mandate of our network company, and we were then advising him on the deal and valuation. So legally we were now the advisors for this company, and we were the investment banker for the entire procedure of deal and valuation. So here we saw that the fund was undervaluing the company in their model. So we had a look to the entire valuation model that the venture fund had created. So we saw that the assumption of growth rate they took was very low, and compared to that the company would be able to grow much faster and much higher rates. So what we did was we created an entire new model with new assumptions and which were backed by research. So here we did a detailed financial model for the next 5 years, calculated the valuation using DCF method, and then presented it to our client and the venture capital fund. So there was back and forth on the assumptions that we took place. There were a lot of calls that we had to attend with the VC fund to explain about the assumptions that we took, what was the research behind that, why were we assuming higher growth rate, and we had to pitch them that you were assuming lower growth rate, and on the historical data we have been growing on the higher rates. So that way, after a lot of negotiation, we had then negotiated a higher valuation from what they had pitched, and which resulted into lower stake. So on the reality basis, we helped the company to raise funding now at 32 crore valuation, and the stake that was diluted was much lower than what they had pitched initially. So 2 crores at 20 crore valuation would result in 10% stake. Now that valuation was increased to 32 crores, the stake dilution was only around 6 point something percentage, which was almost 30 to 40% less than what was initially being proposed to the company. So that is what is impact of the entire financial model. And here with the story we understood that as an investment banker, you have to and be backed by data and numbers when you are creating the entire financial model. So here numbers tell a story. The right model can completely change investors perception and negotiation. That a right model with good assumption and well backed researched data points can completely change investor perception, which is what we also did. That we had now negotiated a higher valuation, and then the entire negotiation was in our side. So that is what is use of financial model while you are working on fundraising deal. Next we are going to see some of the bad models and what are some of the elements of a bad model. So first one is there are hard coded values without explanation. So what is hard coded? So here hard coded means that a particular cell has a very big number, let's assume 1 crore, and there is no reference from where this 1 crore number is coming. So that is meaning of hard coded, that it is being typed manually and there is no backing of what the number is, where the number is coming from. Then there is inconsistent formulas across rows and columns, that when you are going through a particular row you are seeing that some formulas are from which previous slide, some formulas are from two slides previous of that. So that is what inconsistency of formula means. So when you are having a reference check, you have to go too much back and forth and not getting everything at a single place. Then there is no interlinking between statements. So this is also a big problem when you are plugging in numbers manually and there is no linking. So for an example, a cash flow statement is entirely created using P&L and balance sheet. And if you create cash flow statement by plugging in numbers manually, then you will be having lot of reference error when you make changes to these two statements, and you have to then once again plug in the entire data in cash flow and have references back and forth. So that is very tedious to go through and it creates a lot of errors and checks. Next is poor formatting, which leads to hard to read or follow. So a model should be very simple to understand. It should have limited number of sheets. So once a person opens the sheet, he understand what is available on what particular sheet. So that is also a element of a bad model. And next is unrealistic assumptions. So for an example, assuming that your company will be growing 5x revenue in next 6 months, this is very poor assumptions that you can take, which is not backed by data. For an example, if you are assuming that your company is going to grow by 30% in the next 2 years, so if the industry is growing around 20%, then these assumptions can definitely be approved and be justified, because here you can say that you have economies of scale or you have good talent in your company which can give you extra revenue than the industry. So this can be backed and be justified by the model. If you are showing very unrealistic assumptions, like if the industry is going 20% and your company is going to grow 3x in next 1 year or 10x in the next 3 years, then this is very difficult to justify. But a lot of startups do have these kind of assumptions, because a startup company is very small in size, and once the funding of huge amount comes in and the growth becomes very massive, and these numbers can definitely be achieved, but getting these models approved have very less chances. So that is what you have to take care while you are building model, that your assumption should not be unrealistic and it should have data back. So here we have given, if an investor or senior banker can't understand the model in 2 minutes, it's a bad model. Since every investment banker has gone through these financial model in the past, if they have a look to your model and if you are working at a junior level and if they are not able to understand, then it's definitely a bad model and you have to work on your skill set. And even if you are pitching to an investor and they are not able to understand, since every investor gets hundreds and hundreds of model every week, they are very sharp in observing those and having their inputs on what a good model looks like. So if they are not able to understand in 2 minutes, so it's just a reference time that I'm trying to plug in over here. If they are not able to understand in first look, then your model has to be worked upon and made changes to it. So here is an example of a bad model that we got as a reference from one of our client while I was working. This is the mock model of what we had received, and the numbers are entirely changed. So there is no conflict of interest based on the client. Here we can see that the entire color coding in the sheet is very bad, and there are numbers which are placed anywhere in the model which have no use. Then there are color grades which are not relevant to the model, where yellow is used, someplace red is used. You can see that there are huge number of worksheets that they have created in this. First is APNL, BPNL, CPNL. Then there is a consolidated version which makes it difficult for a reader. Then the alignment of worksheet is also not proper, because here we can see that balance sheet, B balance sheet, C balance sheet. Then the consolidated balance sheet is given way too ahead of this entire balance sheets, which should have been over here. Then the cash flow should be next. Then we have assumptions, valuation. Then working capital is given at the end, which is also not making sense, because here we can see that there is a reference error in the value section. There is a error in the cost of equity section, but we can see that the WACC is calculated, which is the most important element of a valuation model, and we can see that it is hard coded and there is no formula plugged in over here, which is not valid. While you are calculating WAC, you have to use the entire formula for that, and that way. So this is one more error. So this is one more error that we have. Next, when we see cash flow statement, here also there are lot of color coding misalignment that we can see. There is yellow, there is lot of numbers written over here. There is a check tally which has a lot of differences in number. I don't know what is this where is this, where these numbers are coming from. So that way we see that this first model is very misaligned. There is lot of color coding misalignment. Then there are lot of reference checks, that is error in this entire model. And finally the worksheets are too much and are not properly aligned. Next, we move on to the second bad model as an example. This was a revenue model that was created by one of the client, and here also we have changed the entire referencing number for this. You can see that the entire model is so much cluttered, and you cannot understand where you should start from. This was a company which was into car sharing, and they had projected revenue for the next coming years. It was done quarter wise, but the methodology that they use, the colors which are not easy to see on the eyes, if you fill up the entire cells with color, it becomes very difficult to see what are the inputs that you have to see at. Next, we see that these are some of the elements which are on the same sheet, but we don't know what are the uses of this. Then these should have been on different sheet, and then there should be a single master sheet which should have combined everything into small concise data. Have everything on a single sheet, which makes it very difficult for us to understand. This was the second sheet that they presented, and it was also very cluttered. This way we saw some of the bad models that were presented, and how you cannot make such mistakes while you are working on your financial model. So after going through the real life bad models, we are now finally on the last point, that is what are do's and don'ts of creating a financial model. So first we are going to see the do's, and then we can move on to the don'ts. So first, keep assumptions realistic and well researched. This we have discussed from the start, that when you are building a model, your assumptions should be backed by research. The growth rate that you are predicting has to be well defined and well justified. Next is maintain clean formatting and color coding. So this is also one of the most important, as we told that, as we mentioned, that your model should be understood in just a single glance. If you have good color coding and clean formatting, then it becomes easy to go through the model in first glance. So that is very important thing. Next is make model dynamic, use links for. So a dynamic model is opposite of hard coded numbers, where every cell of your financial model is linked to the original cell that you have put in. So that is about model dynamic. Next is document all logic and calculation. So whenever you are doing research to put in assumptions in your model, document all the logic and calculations that you have used. So for an example, you see that 10% industry growth rate is predicted for the next 3 years, and in your model you are using a 50% alpha, that is your company will be going by 15% for the next 3 years. So why is this 50% alpha used? That you have to show in your logic and calculation. Is it due to less of is it due to more economies of scale? Is it due to less manpower required than the industry? Is it more talent? Whatever is it, you have to show that logic and calculation. And final point is build modular, that is everything should be in the model, your inputs, your calculation, and your output. Moving on to the don't sides of financial model. First is avoid copy pasting random formulas. Here lot of times people plug in into a chat gpt a formula for xyz thing, and they plug in directly into excel bar, which gets a lot of referencing error. And because you have not understood the logic properly, there will be lot of errors in the entire financial model going ahead if it is linked with one another. So avoid copy pasting, understand the logic of formula, and then only use it. And try using simple formulas. Don't complicate your financial model. Next is don't hard code everything. Definitely there will be some points where you have to hard code numbers, but don't hard code the entire model. We talked about cash flow statement earlier. It should be entirely linked with the PNL and balance sheet that you have created, and nothing should be hard coded in cash flow statement. Next is don't ignore consistency. Whenever you are aligning or using any type of font size or color, that entire thing consistent in the entire financial model. So let's assume that you use Calibri as your font type. So use Calibri in the entire financial model. If you are using font size 9 for all the numbers, keep it at 9 only for the entire model. So that is what will help your model to be more clean and formatted and easy to go through. And finally, don't use assumptions you can't defend. This becomes one of the most important don'ts when you are creating financial model, because your financial model will travel to investors, to your seniors. There will be a lot of questions by them, and if you have plugged in any kind of inputs that you cannot defend, then it's a problem for you. So here we see that the first element of the entire financial model is profit and loss statement, which we have data for the first year. We are going to build the three financial statements for the first year as well, and then we are going to then put in inputs for year one, year two, year three, based on the assumptions that we are taking for this company, which is Sandwich Private Limited. It's a sandwich seller which has an outlet, and we are going to predict what are the revenues, P&L statement, balance sheet and cash flow for this company. Balance sheet, where we are going to model for non-current asset, current asset, total assets, non-current liabilities, total liabilities, equity, and then tally the entire balance sheet. Next, we are going to see two schedules which are most important. First one is fixed assets schedule, then we have borrowing schedule. And finally, once we complete these two statements, we then build the cash flow statement, which is entirely linked from P&L and balance sheet. We build it for the first year using CFO, that is cash flow from operation, cash flow from investing, and finally cash flow from financing, and then calculate the net cash flow. We are going to understand each line item's logic in detail, that how is it calculated, what does it mean, and how can you plug in and link with P&L and balance sheet. So that is entire model that we are creating in this course. So hope this video added clarity to what is a financial model and why is it created. In the coming sessions, we are going to create our financial model from scratch, where we are going to create the financial statement for the entire first year. Then we are going to model it out for the next 3 years. So hope to see you in the next session. Until then, this is Karan Damania taking your